Yeah, I'd like to welcome everybody today to our first my first financial talk. I'm hoping to do a lot more of these. My guest today is Justin Chaput from Talbot and Associates. He's a CPA, and one of the things I'm so excited about, why I'm so excited about this webinar is I love talking to people who are equally passionate about what they do. Um, with their careers and how they work with clients. And that's, I just really found that with you, Justin, that you're a passionate guy, you love what you do, and you really want to make a difference, right? So welcome.
Yeah,
Um,
thank you. Thank you. I
yeah,
know
yeah,
people usually have maybe a stereotypical idea of what accountants are, and maybe I'm that. I don't know, but I definitely love my
yeah,
job, and I definitely get excited about accounting and
yeah.
tax, which I don't think many people out there can
No,
can can
no,
say.
yeah.
So hopefully
Well, a
my
lot of people
my
say that same
passion
thing
and my
about,
excitement about this world
yeah,
can be felt by others today.
yeah. No, I hear you. So I included a quote from Albert Einstein. The hardest thing in the world to understand is income tax, right? Um, And I tend to agree with him, I think, right? You know, it's a pretty complex area, I would imagine, or I know it is, right? So,
Yeah, like listen, I deal with the income tax almost on a daily basis, but there's so much. If you ever see the Income Tax Act, it's like a document that's like this thick with like
mhm.
Bible papers
Yeah,
and hundreds of, if not thousands of rules. So it's really hard to know it all.
yeah,
And even I work in an accounting firm with about another 60 or 70
mm,
accountants, and there's probably not even one of us that knows really all the
right,
rules.
yeah, and I mean, over the years, it just gets more complex, I guess, right? They just add more rules and they add more stuff, add more tax, right?
Yep.
Yeah, yeah, yeah. Um, so yeah, so it's definitely a big part of what we do over here as a financial advisor as well, because it does play a big part of how you accumulate wealth, right? And that sort of thing, right? Um, so let's just start with a quick intro. One of the things I always kind of like to do is always work with teams, with more people, right? Because I only do one or two things really really well, right? And I find that bringing other people who have different skills than I do can really provide a much better type of service, right? Would that be a fair statement, you think?
Yeah, yeah, like
Yeah.
yeah, we can't do it all. Even I said a little moments ago, I work with a team of, 60, 70 other people. Without them, I probably wouldn't be able to do my job as
Hmm.
well as I do. So I try and focus on what I do best, and put people in contact with either
Hmm.
colleagues or other professionals like yourself,
Yeah.
Ray, when they need it. So
Yeah.
you got to work as a team these
Yeah,
days.
no, and there's always somebody on your side, right? You know, like there's always somebody to fall back on, and I think that's kind of an important part about working as a team. Tell everybody a little bit about myself. I started in this business back in '96, so back in the 1900s. You know, um, been around a long time, and I literally met it. You know, you name it, I met them and talked to them. So it's been a quite a wild ride, and ended up with CP Nouse in 2019, which of course is a division of Case, right? So for myself, what makes me really excited about this industry is definitely looking at tax and the generational wealth transfers. I love every aspect of that because it's to me it's the kind of area that I can make the most um, different the biggest difference in, I guess, right? Um, and a little bit more about myself. You know, I'm a pretty simple guy. I'm a farm boy originally, and love the outdoors and have lots of kids, and I just really hate taxes. you know, but ultimately I work for my clients, right? I answer to them, and I did a lot this year, and really I like to go the extra mile. I like to do everything I possibly can to provide that best possible service. I even get in trouble sometimes for it, right? you know, but that's me. I been here a long time and very very fortunate to be where I am today. What about you, Justin? What do you
Yeah,
find?
so like I started my accounting career 2001, pretty much right out of school. So from my entire working career, if you will, has been with Talbot Associates.
Oh, good for
Very
you.
fortunate that they were
Mm,
able to provide some opportunities along the way, and at some along the way, I became a partner of the firm, and one of
mhm.
my responsibilities here is the agriculture team.
Okay,
So
okay, yeah,
being in Manitoba, we do have a lot of rural, we have a lot of farming clients, although that's not my entire practice, but
yeah,
so much so that we have a dedicated team just for our agriculture clients. And in link with those agriculture clients, I consult quite a bit on capital gains and capital gains planning and the opportunities that come with that. Although it's not a point here, but I also hate taxes. But where I get my joy day to day is how do I minimize
yeah,
taxes for our clients.
yeah,
And I know taxes can be daunting and taxes can be a big topic, as your the first slide mentioned there. But I like to try and pride myself to able to explain things to clients in a clear fashion so they can understand as best possible. So
yeah. Well, I find that it's easier for them to make a decision if they actually understand what's going on instead of looking
right,
at you and
yeah.
going, "What would you do?" You know, you know.
Don't get me wrong. I feel a lot of clients put a lot of trust in our hands, and I
Mhm.
like to believe rightly so. But I don't like when clients are walking out the door and you can tell that they just didn't really understand and don't get it. I feel like
Yeah.
that never leaves a good feeling in for
Well,
anyone.
to have a really good relationship with our clients, I would imagine, I believe that anyways that there has to be a certain degree of or a high degree of transparency, So it's important for people to understand what we're talking about a little bit, right?
Yeah.
Um, love this cartoon. I compare it to like sometimes I come back home and I'll talk to my wife and I says, "Hey, I can't believe what my friend did, or I can't believe what my colleague did, or what he's doing." And my wife will turn to me and say, "Hey, you do the same thing." you know. And we have a lot of these type of financial talks with clients, right? And so it's important to try to put things in perspective a little bit. So about the meeting, everyone. The meeting is really we just want to talk about financial stuff in everyday language. We don't want to confuse you. We want you to come out of here a little smarter, right? So we want it to be relatable, informative, interesting. So I've been doing this a long time, and people go, "How do you make financial stuff interesting?" you know, well, we do our best, right? It's definitely not the you're not going to the comedy show and people are going to do a show on, on finances. So, but we're going to do our best here. Um, so, a couple of things we all have in common, right? We've all heard this before, and one of those things is definitely our greatest bill is taxes, right? Um, it's just the everyday life. So let's look at that a little bit. Um, right, taxes are necessary, right? Without them, where would our country be, right? So um, I think that definitely it's something that we hate paying, but it's absolutely necessary for all the stuff that we get out of this country, from our medical to our roads, even though they're sometimes not so great, right? But we definitely need that revenue coming in into our country. Thing is that we have no control on how it's spent, right? That just you know pie in the sky to think you'll be able to try to you know have any type of control over that. But the biggest thing, I mean, something we really want to focus on is how it does decrease rates of return, right? Um, so my reaction to these facts is that I personally pay more taxes than I keep. Right? I'm an employee. I'm in the wrong tax bracket. I don't got much for write-off. Um, so it really hurts me as that as they don't have a lot of options when it comes to write-offs, right? So, where does it go from here? Is kind of always my, how do we manage it better? The no control thing, we can't do anything, but we can be aware of the changes, we can manage them and vote, even though it doesn't seem to matter by the time it gets to Manitoba, right? um, so the opportunity for us is, if we decrease the tax rate, we increase your rate of return, right? And there's more than one way of making money, and one is definitely getting out there and investing and having fun, right? With that, but the other one's is decreasing cost and your taxes and that sort of thing. So we're really going to be focused on that third point today. So taxes, right? Employment income. I like to look at things on a large scale sometimes, right? Not a lot of people who make $1 million a year, but this comes up a lot in the States where people die with a lot of RSPs or pensions. You probably see this quite a bit, hey, Justin, where
Yeah. As much as, this is maybe far from, regular individuals, but it's not necessarily all that far fetched in the context of an estate or a final return to have accumulated wealth or have deferred some of this income or some of their this value. So it's not
yeah,
completely out of the realm of possibility, but I think
yeah,
the point here is to kind of just generally show how employment income or generally other sources of income which can fall in that same category can compare to capital gains and being taxed on capital gains when you can or plan your affairs in a way. It's quite substantial by those bottom numbers right there.
yeah,
How much a
yeah,
difference that can make.
yeah. No, it's we definitely want to earn capital gains. It's definitely uh, you know it helps our clients grow wealth a lot more, right? The mutual fund industry is create capital gains, but Revenue Canada sticks their nose in there every time and changes stuff for us. So, um, so it's let's see here. So 2022 didn't really create too many capital gains, right? We created there's more capital losses than gains in this past year. So if you're in oil and that sort of thing, we did see some gains there. And I like putting up this cartoon because definitely, 2022 was not comfortable for my clients. We're definitely talking to our clients throughout the year, try to make sure that they're okay. But it does affect us as well. Like we're tied to our clients, and we hate having years like this, right? I'm not at this point where I'm ready to jump off the ledge, right? But you know, it definitely was a difficult year. Um, so a lot of people say, "Well, what now?" kind of thing, right? And it always reminds me of the saying that Warren Buffett kind of coined and made famous. And be fearful when others are greedy, and be greedy when other people are fearful. And I can tell you right now, people are fearful now, right? Like everybody throughout the year, I've had a lot of conversation, and people really think that that's it, no more. Everybody, the world's coming to an end, and we're going to lose all our money, and it's really, we kind of have a talk about long-term planning and do all that stuff still, but it definitely, was, a year of helping clients through this difficult year, which produced some capital losses, which, like I said, it doesn't make people feel great, obviously, right? Nobody wants to go there, but it is part of investing to a certain degree. But those capital losses can be used, right? And it can be used in as a tax advantage. So, and hopefully make you feel a little bit better about it. So Justin, you really are the expert on that side of thing, right? So I really want to defer the tax stuff to you, right? And talk a
Sure.
little bit more about that kind of stuff, capital losses and capital gains and whatnot. So what do you think about all that?
Yeah, so first let me lay down some groundwork here a little bit and just go over the general concept of capital gain or capital loss. And so a capital gain is calculated as whatever your sale price is, we'll say of an investment or even real estate, less its acquisition cost. So I think
Mm,
that's relatively straightforward, or hopefully it is. So when you're selling these properties, you're not paying taxes, or you're not recognizing the income on the sale price itself. It's the difference, or the variation in the investment from the time of acquisition. Now, what makes um, capital gains so great as a type of income, to a certain degree, on the flip side, the losses, is that calculation, only one half of it um, is what we call a taxable gain, or net loss, and that's what goes on your tax return. So unlike, we'll say, $1 of employment or $100 of employment income, that gets put on your tax return as $100 of income. Well, $100 gain ends up only being put on your tax return as
Mhm.
$50. So there's a big power to that right off the bat, that only half of in essence, the income or the accrued value ends
Mhm.
up being taxable. What's really important, however, to note is when we are talking about capital losses, and maybe not a lot of people realize this, is that if you have a capital loss, and maybe, sorry, I'll quickly jump to the point right after, is so we're clear, is that capital losses can only be applied against capital gains. Now, if you have more capital losses than gains in a particular year, what's important is to realize is that's not wasted. And there actually could be benefits, or opportunities to be had, especially knowing that a capital loss can be carried back 3 years. So in other words, you have more losses, you don't have a use for them, or you can't use them this year because you don't have gains to offset. Well,
Mhm.
maybe you had losses in the last 3 years. Now, if you didn't have losses in the last 3 years, or you don't want to carry them back for whatever reason, you can also carry them forward indefinitely and use them against future gains. So the
Right.
power of carrying back and carrying forward is a lot of where the planning can occur when you do have capital losses. And I won't go as far as saying you should be triggering capital losses, but if you do, along with discussions through your financial advisors, your financial planners, that it might be the right time to recognize some of those losses, where is the opportunity in those losses? There's no such thing really as a time machine, but this loss carryback option can give
Yeah.
you a
Yeah.
lot of opportunity there to recover taxes that you might have had to pay in prior years, and might have had to pay at a higher rate because it was in a higher tax bracket.
Right.
So
Right. So how useful is this, like, I guess, in say somebody dies and now you have the wife or somebody else looking at taxes, and now they have, let's say they had a capital loss that year, or that sort of thing. Can you go back with that person who's died? Can you go back and do anything there, or how does that
yep. Yeah, so
play out?
typically the individual who's responsible for that final return, usually the executor, could be a spouse, could be another family member, can definitely make the decision to take those losses and carry them back. But in a situation where somebody's passed away, there's no more carry forward ability. But before we consider carrying a loss back on an estate, or I should say a final return, there's actually a big benefit of capital losses in the year of death, because unlike any other years, a loss incurred in the year of death can actually be offset against any sources of income.
Oh, okay. I never knew
Okay.
that. Mm.
So
Yeah.
again, opportunities to be aware of and something to think about, that whoever might be assisting or helping, or a professional that you'd be going to for taxes, you got to make sure that at the very least they're aware of it. We're giving you this information today so that you're aware of it. The point being is there are planning opportunities.
Mhm.
And if you're only focused on the here and now, and not realize or not know, or you're not having these types of discussions with your professionals, you could very well be losing out big
Yeah.
time. And some of these losses, which again, not great. Ideally, I would hope none of us ever have losses, of
Yeah.
course, but when you do, boy, when can we really take advantage
Cool.
of them?
Yeah. Absolutely. So. Okay.
Right?
And yeah, you know, it's basically half the tax, right? With a capital gain, right? So I'm gonna go to the next slide here.
Yep, sure.
Yeah. Okay.
So again, a little bit more on the losses and how they can be useful. And just finished mentioning, nobody likes incurring losses, but as Ray mentioned, and as I am exposed to, as a lot of others, is yeah, we did see some potential
Yeah.
losses this year, and unfortunately, yeah, I have to look at it as almost like a fact of life, right? Depending on what you're invested in, is yeah, you
Hmm.
have to be prepared for
So
it.
just a quick question, like you know, I'm in the investment side, so I'm always dealing with investments and capital gains and capital losses on the investment side. And of course, there's land. Um, but capital gains can be created, I guess, or capital loss can be created in other areas, I would imagine, right?
Yeah, so it's anything a capital gain or capital loss would be incurred on an asset, and an
Mhm.
asset can be investments, it can be shares, it can be mutual funds, it can be land, it can be farmland, it can be a rental
Yeah.
property, where the idea is that you've acquired this asset with arguably the hopes that it appreciates or increases in value, and that's part of why you're investing in it. So maybe that's not the exclusive reason for like a rental property per se, because the rental property will earn annual income. I guess stocks, bonds, mutual funds will give you annual income as well. But there is still a general sense or general idea that I'm putting money into this. It's creating a pool of capital, and hopefully eventually it grows in value, right?
Mm.
It's not part of these slides, and then Ray, you and I never really discussed this, but there is arguably a fine line as to how much activity that you're doing that may be viewed as a capital gain. So I'm calling that like a day trader, somebody
Right, right.
who actively trades stocks on a daily basis, and that's in essence their job. That you gotta be careful with. Not many of us do that. I'm going to broadly assume not many who are part of this presentation do that. But if you do too much of it too regularly or too often, and it becomes your day-to-day activity, you lose that ability to recognize that type of income as capital. It could actually turn into like straight income or employment income. Anyways, I
Mm.
in my line of work, I want to say that I've met less than a handful of
Yeah.
clients that are what would be considered day traders.
True.
But
Okay.
yeah, don't walk away from today's presentation going, I'm going to start day
Mm.
trading to get these capital gains because they're so
Yeah.
great. And Ray and Justin said they were great. And one of the best ways, types of income to be taxed on.
Yeah.
Um, just be careful, if you
Careful.
will.
Yeah, absolutely.
Okay.
So let's take a look at those taxes.
Yeah, so really, whether you're aware of it or not, I somewhat apologize. There's a lot of numbers here. This is a lot of data you might be seeing
Mhm.
on the screen, but the idea here was to show you that in Canada, more specifically in Manitoba, we have different tax rates on different types of income.
Mhm.
So other income is kind of the catch-all. So if it doesn't fall in any of the other categories, it's deemed to be other income. So employment income falls in there, interest
Mhm.
income falls in there. So not only are there different tax rates on the different types of income, there's actually higher rates the more income that you make. So if you focus or you look even just at the capital gains column there, you can see that by and large, maybe not for every income tax bracket, but
Mhm.
as a whole, capital gains are significantly, the effective tax rate is significantly lower than other sources, especially other income. So
Yeah.
the argument here is if you can turn your types of income into capital gains when it's the right thing to do, maybe as your overall planning, maybe even over portfolio. So don't get. I'm not saying invest everything or do everything to exclusively get capital gains, but what you can possibly shift over to capital gains, excuse me, you definitely want to do. So
Right.
even just that bottom line there, which is the highest marginal rate, and that 50.4%, part of my language makes me
Mhm.
want to puke a little
Yeah,
bit,
no, it gets
because that is arguably a really high rate.
yeah,
But that's on other income. So what if we just had it in capital gains and it's half the rate, and
yeah,
that's not surprising because only half of the gains are included
are
into
included.
income. But you can see how significant there's a difference. The highest capital gain rate
Mm.
is still lower than the lowest other income
Yeah.
rate.
This is what we look at, especially in the RSP time. If you go, well, how much should I buy? Right. Um, just to simply try to have the biggest bang for their RSP purchases, right? When we're doing the tax plan. So great chart. I love how that's
Yep.
illustrated and shows how much we pay too much in tax.
Now, those rates, what's important to realize as well, because there's different brackets and different incomes, is there's a game to play, if you will.
Yeah.
And I'm not trying to make a joking matter out of income taxes, but in a way, and for people like me, um, it's a game in the sense of like, how do we use those rates and those different brackets to our clients' advantages. So I want to avoid my clients being in a higher tax bracket if possible, if they can plan their affairs in a certain way. And more specific to losses, and even more specific to that, is the idea of losses being carried back or carried forward. Is if you have a capital loss this year, and you compare that to prior 3 years where you had capital gains, and maybe those capital gains threw you or put you into a higher tax bracket because it was the right decision to incur those gains in prior years. Well, here's where a loss can be super powerful. You take that
Yeah.
loss, you carry it back, you not only save taxes, which is good in itself, you're saving taxes at a higher rate
Level.
by bringing
Yeah.
yourself down to a lower bracket. Now, if it's not in the prior 5 years, you can arguably use the same idea of carrying forward. You can carry forward those losses. Now, it's be tempting to take those losses, we'll say on a carry forward basis, and use them as soon as possible. So if you kept carrying them back 3 years, and you're carrying them into 2023, and you got gains in 23, I wouldn't. My piece of advice would not be to automatically claim those losses against 23 gains.
Yeah.
Let's look at the situation. Like, are you maybe in a higher bracket? And if so, yes, let's consider taking those losses
Yeah.
now. But if there's a higher likelihood that you will be have more gains or more capital gains in even future years, 24, 25, 26, these can be carried indefinitely. So why not use those,
Use
or
those.
plan for them? Now, nobody has a crystal ball, just like nobody had a time machine, but there's a certain degree of estimates and projection and planning that can be done. And that's the point, is plan your affairs, speak to your professionals, and plan your affairs in a way that you're taking full advantage of these opportunities that are given to you. Yeah, nobody likes paying taxes, but if you can play the game and pay the least amount of taxes, don't take that as me recommending any kind of level of tax evasion. I do not deal in tax evasion, but
No.
boy, do I
Talk to
deal
avoidance. There's
with
bad
any
roots.
rules that are given to you that you can take advantage of, that you can play with, so to speak. Why not? They're there. It's already complex. We already pay a high level of taxes. Why not take
Yeah.
advantage of what's given to us in those rules,
Yeah.
right?
So I see capital dividend account here for corporations. So for people who have
Yes, yes.
businesses,
So a couple other things to keep in mind, and some of them we mentioned a little bit, but I'll focus my attention on capital dividend account, or CDA for sure, short, if you ever hear that term. It is unique for corporations, so not individuals, but individuals tend to be the people that own corporations. So if you're a corporate owner, this CDA is terribly powerful, and not a lot of accountants, I'm sad to say, recognize what this is and what can be done with it. So in essence, what a capital dividend account is an amount that sits at the corporation's level that can be paid out to the shareholders, or arguably the owners of the corporation, on a tax-free basis, right? And there's not a lot of things in life that are tax free, but this
Love that
capital
word.
dividend account, what's that? Sorry.
I love that word, tax free, or that phrase, tax free. You know.
Right,
Yeah.
right. So, if you are a corporate owner and you've never heard of this term, like at least a take home today is investigate if your corporation has a capital dividend account. And if so, well, I would highly recommend that you consider taking the steps to pull that money out.
Yeah.
Now, maybe I'm oversimplifying it. There's more complexity to the capital dividend account, but still, I'm not wrong in saying what value or what amount is sitting in that account can be paid out
Yeah.
tax free.
So how is this created, the capital dividend account? Like how
Okay,
does a
yeah, that's
corporation get
that's
one?
fair. So if the corporation earns different sorts of income, so a corporation itself can earn capital gains. So if it earns a capital gain, the non-taxable component of that gain, so the one half that is not taxable, goes into a capital dividend account. Um, Now, another prime example of what goes into a capital dividend account is life insurance. So if a corporation owns a life insurance policy, and I think Ray, you'll present a little bit more on that in this presentation, is there is a large portion of that life insurance, and in many instances, all of the life insurance proceeds that are paid out on a death benefit can go in the CDA and then all of a sudden be paid out. So that can turn into a very effective planning strategy or investment planning strategy for a corporation.
Oh, it absolutely is, right? So yeah, it's I find in the, I mean, I'm not the accountant, but we're the ones that sometimes create those credits, right? And over the years, like how it's very useful really for let's say if you have partners and one of them dies, or if it's a farm or whatever it is, there's going to be some kind of succession or generational transfer at one point or another. And these CDA accounts really come in handy in order to facilitate these major changes in business and corporations and farms and whatnot. So
Yeah, absolutely, because it can it's somewhat in some instances even the playing field. If you're buying
yeah,
out we'll say a partner or like you said, Ray, somebody passes away. So
yeah,
again, I can't say enough about the importance of knowing about the CDA or reaching out to your professionals
yeah,
to ask about it and not leave that on the
yeah.
table, right?
So the capital gains exemption. I'm sorry, just start something about the capital gains exemption. Um, are the rules kind of finicky in the sense of who can actually apply their capital gain exemption to?
Yeah, there are definitely conditions that need to be met. Okay, so the capital gains exemption, it's almost in its title that if you earn certain kinds of capital gains, they could be exempted for tax purposes. But there's only really two main categories or types of assets that can qualify for this exemption. So that would be shares of a small Canadian corporation, which are usually corporations that are owned by individuals, controlled by Canadians, um, or farmland, but more specifically, qualified farmland. So not all farmland qualifies for the exemption, just like not all shares of small corporations qualify for the exemption. There are specific rules that I don't think I'll go over on the presentation today. You definitely need to be on side and to meet those rules. Because if you don't and you fall offside, guess what? You might be using the exemption, but incorrectly so, and then you get a rude surprise. So I can
So
share an example is it was we took over a client, or arguably a new client to our firm that had used the capital gains exemption in a prior year. So either the prior accountant or the prior tax preparer had claimed the exemption, but under the wrong understanding of how it worked. And unfortunately, this individual CRA kind of looked into it and challenged that exemption, and there was just enough for that individual to be offside to meet the rules of the exemption, and all of a
Yeah.
sudden that exemption just disappeared. The exemption is fairly large. It can be
Mm,
up to, you can use, it's a lifetime exemption. So once you've used it up, you don't have it anymore, but it's a lifetime exemption up to about $970,000
mm,
on qualified shares. So that's a huge amount.
mm.
And very close, getting or close to it is $1 million on farmland.
So
But
don't so
again,
yeah.
yeah,
So the moral of the story is don't assume you can use your capital gain exemption.
yeah, it's
Yeah.
it's it's there. As I mentioned before, it's there, it's a rule, it's something you can take advantage of, but you gotta make sure that you're taking advantage of it correctly or that you meet the recommendations. Sorry, the requirements of
Requirements.
meeting. And
Okay.
that's something that
Right.
can be planned as well. So if you're
Yeah.
not meeting it, the rules or the requirements right now,
Yeah.
you can plan your affairs in a way
Yeah.
to get yourself
Right.
there.
So I like to throw this one up a little bit. We don't have estate taxes here in Canada, but the point of the story is your biggest tax bill will be your final tax bill generally, right? So that's kind of how I look at this cartoon, right? If you're in the States, you're looking at this going, oh, that's not funny.
Well,
Because
that's
that's
a
how they get you when you're dead there. They don't tax you as much when you're alive, but they do get you when you're dead. So it's
now, I know this is a little bit outside of the scope of today's presentation, but it's not that uncommon that people defer taxes into the future. In fact, deferring
mm,
taxes in the future to a certain degree is a good thing. It can be a powerful thing. But if you defer taxes too much into the future, you've just left that much more pot to be taxed upon your passing. And
mm,
here's the word again, planning. If you haven't planned for that, well, to a certain degree, maybe you don't care so much because
yeah,
you're gone, and I like to believe
yeah,
gone to a better place. But
yeah,
but you definitely left something on the table that can
on the
be just as
table.
frustrating,
Yeah.
right?
Well, that's what I find is that that final tax bill is a bit more, like than just a regular, return, right? It's literally your last financial transaction, right? So it's I think important
Yeah.
to take that a bit more seriously. Um, so I like putting some interesting stats on taxes because I just find it very interesting because like, people don't even realize we used to say a billion was hard to conceive, but $1 trillion is an amazing number, right? So US collect $4.9 trillion in taxes, right? And they have 332 million people, right? Um, but the interesting is China collected less and they have literally over a billion people more than the States. There's no point there. I just think it's interesting, right? Um, Canada collected, we're not at the $1 trillion mark, right, yet. And our population is 38 million. So, like it's just, we have a tenth of the population as the States does, right? And I don't even know how to calculate what it is with this, with China, right? But you know and we talk about immigration, that sort of thing, but it's because nobody lives here. Nobody wants to survive these storms that we're going to see today and tomorrow and you know and whatnot, right? But really to kind of put the point through is that we would collect 35% more tax than the US if we had the same population, right? So we're heavily taxed in this country. So we still have a great country. I think it's an amazing place to live, right? But definitely, it's a tough one when it comes to taxes. So I'm just gonna move on a little bit more, and one of the things I always kind of talk a little bit about is we all know like people can really only do one or two things really, really well, right? And really, same goes for products, right? If you have an RSP, it defers tax extremely, extremely well, right? You have a corporation, it defers tax extremely, extremely well. But let's say it doesn't eliminate tax, like so if an RSP, I'm sure you've seen this before. People are loving to buy RSPs while they're working, and then they retire and they go, "What the heck? I gotta pay tax," right? So so I always say, you can't just buy one product and think that you're going to be financially good, right? It takes a combination of products that do certain things. You focus on what that product does well and be aware of what that product doesn't do for you, right? And then you kind of go from there. That's how you manage these kind of things, right? Um, And there's really no cookie cutter way to doing financial planning or building a financial plan. And there's probably not a cookie cutter way of doing tax planning on the accounting side too, either, I would imagine, right? Um, and really, that's because everybody's different, right? Um, and today, one of the things I wanted to kind of bring up is more that we're here to talk about how to just really do tax management, right? Like, so we have capital losses, how to use it about capital gain. What's a capital gain? What's a, and all these various things. But one of the things that clients don't really realize that one of the most tax effective tools in Canada is a permanent life insurance policy. And permanent life insurance, a lot of people are related to your home insurance, all the insurance that we buy on appliances and that sort of stuff. And it really isn't that, right? Permanent life insurance is just another financial vehicle, another financial account, like an RSP and that sort of thing. They follow different rules. And permanent life insurance is the easiest way I can explain it is you start an account, you put money in there. When the insurance company says, hey, you know what? If there's a future value there, right? You invest, you put interest rate, and it grows to a certain amount. What the insurance company is saying is, hey, if you died, 2 years into this, we're going to promise you that we're going to pay out that full amount anyways, right? Because it's a terrible time, right? So it's really like a GIC maturing upon death, right? It's an estate tool, and it's a very effective one because that's why people do it, right? Now, let me make it clear: you don't need life insurance, right? Like it's not something that you need. You're dead, right? You're no longer here, right? You forfeited all your wealth, and you can't take it with you, right? So it's not about a need or you need to do this. It's more, a financial tool people use in order to combat taxes. So you can either use insurance or you can pay the taxes, right? I'm good with whatever you like, but I think it's important for you to be aware of the two, right? And really, people who have something of value, when they have something of value, they insure it. And we're probably the most important people to somebody, right? So important to kind of take that into effect. But really, what it boils down to is it's really the wealthy people who implement permanent life insurance. I mean, there's a lot of my clients who do small little policies to make sure that nobody has to put up money for their funerals and that sort of thing. When we look at the major cash flow coming into permanent life insurance industry, it's from the wealthy, and it's because they have more to protect. They have more bigger tax bills, and they really just want to be able to manage that a little bit better, right? Because really, when as a financial advisor, I have to look at various areas. I have to look at, we all have basically three problems, right? Either we live too long, which is probably one we spend the most on. People are living a lot longer nowadays, right? And this one's the predictable one, most likely, right? So we plan, I'm sure this comes up in the accounting industry as well, where you're planning to make sure that everything is ran properly. If you died a bit early and you got the will and you got things set up. But really, that's where we spend a lot of time. But I have to consider that my client might die or too soon or get sick, right? Because that changes a lot, right? And ultimately, we have to absolutely consider in our plans and when we manage money, um, what happens when that guy dies or that person dies. And I can tell you it's 100% certain if you didn't die before 65, you'll die after, right? So this event's going to happen. And so you should plan for it. Um, so in your experience, like when you bring this up, wills and dealing with taxes upon death and stuff like that, it must come up in conversation quite a bit.
Yes, so I know that I always recommend our clients that at the very that they have a properly worded will to kind of help to manage whatever might be that the tax liability upon passing.
Mhm.
It can be really simplistic, and I'm going to use a personal example. Whereas my parents or my father was, my will just says when I pass away, everything gets divvied up amongst the children, and that's fine. That's what his wishes are. But sometimes we want to take it a step further, and I'm not in the business of telling people what's in in their will. I tried to tell my father, and that did not play out very, very well. But even as an accountant with our clients, I don't necessarily try and go out and say you should have this or that in your will. My job is let's have a discussion about what your concerns are and
Yeah.
maybe what we can plan. And these three, well, three or two pillars is what if you live longer? What if you die sooner? What are things that can be put in place that will give you, or I guess your executor, and more specifically your beneficiaries, the most power to manage the tax load that could
Yeah.
occur.
So, and yeah, it's I find it's always sometimes an eye opener for clients once we start reviewing what that looks like, that final tax bill, right? And it's I think it's nobody likes to talk about this stuff, of course, right? Who wants to get up in the morning and talk about death or dying or that sort of stuff, right? It's one of those things that you know people really aren't too excited about, like buying a motorhome or snowmobile or something, you know, right? So,
Right. Yep.
yeah. So I know this can be overwhelming, right? It's definitely something that you should be talking to people about. If it's not, if you have advisors, go see them. If you don't, come see us. But it is something that it's way easier to contemplate. A lot of people come to see me about wills. I have a will checklist, and we come and talk about it. And like you said, we have a discussion. I'm never going to tell them what they have to put in their will, but it's I think an important aspect to be able to answer those questions that we have for them. You so so we're going to look at a few quick examples, and then we're going to let everybody move on with their day, kind of thing. Um, and I have a couple examples, and the first one is just more or less an established corporate business owner. It could be a farmer, it could be any type of business, but he's just a younger person, right? Before I get into illustration, I always say, remember that all the numbers that we use are just really numbers. They don't mean anything. They're just really there to kind of show how the concept works, right? And everybody's number is different, right? So again, there's no cookie cutter way of doing things, right? And we're really trying to get away from that first cartoon that we showed, right? We want to be able to show different concepts to people and be able to elaborate a little bit why these are work better for that specific client, right? But I'm going to go and the first one is just a regular business owner. He's 45 years old. He's been doing well. He's established, and he decides, he's paid off the house. I'm going to put 25 grand away every year inside my corporation, right? So he's going to invest or create a holding company or something. And he's going to take 25 grand. He's going to strip 25 grand from his profits because he won't miss it. And he's going to start investing for the next 20 years. So one of the questions I do have, like, money that's invested inside a corporation, even like rent and stuff like that, is it taxed differently than personally?
Yeah, so the business owners, corporate owners do need to realize that investment income itself is taxed at higher rates in a corporation compared to what I call active business profit. So if you're in the business of building widgets, the profits on that relatively low. It's actually 9%. But if you are starting to accumulate value in the corporation, excess cash is what I often refer to. You want to do something with that excess cash, you can put it under your mattress if you want, although I would not advise that. But you start investing in other things, stocks, bonds, mutual fund, rental properties, and all that. Depending on the type of income that gets generated on there, you're being taxed at arguably a significantly higher rate. So different types of incomes would be taxed differently. I'll
Yeah,
give you the highest range. It's not meant to be a shock value, but the highest rate of tax upfront on certain types of income. Interest would be one of those. Rental would be another one. Could be exposed up to slightly over 50%. So not terribly different than the
yeah,
highest personal marginal rate
yeah.
there. So that's not great
No,
either.
right. So, um, so yeah, so thank you for that. So we're definitely inside those corporations. It's not a bad place to invest, but we always want to try to have that tax conscious mind, right? But this guy, over the years, he did pretty good. He built a portfolio. He deposited 25 grand until he was 65. At 65, he says, you know what, I'm going to retire and I'm going to take $25,000 out now, right? So he decides to take $25,000 out, which is a taxable income, right? He takes out, just like if you take money out of a corporation. Um, and he does this for 20 years, and at 85, 86 years old, there's still $500,000 left in that fund, if you will, in those funds. And then he died at 86. Then his estate value to his kids would be 300,000 or a little bit more than 300,000, right? So this is a very typical way. It's probably what you see the most of out there, I would imagine. And there's nothing wrong with it. Somebody would look at that and go, "Wow, okay, no, I mean, it's not terrible, right? My kids are still getting some money, and what are we gonna do? We have to pay lots of taxes anyways, right? We did well, and now we're paying taxes, right?" So it's not a terrible way of looking at it, but remember, you're taking income out, you're paying taxes. You die, money wrapped up, and it goes to your kids. You pay more taxes, right? Um, at times, we'll look at that same 45-year-old owner and we'll say, hey, instead of putting it into this, let's take a look at putting in permanent life insurance, right? So this works a little differently because permanent life insurance, again, is a tax haven, regardless if it's personally owned or inside a corporation. So what this does, actually, there's cash values that build up in that policy. Those cash values build up your balance sheet, and they're also 100% guaranteed. So once the money's in there, so if it's $300,000 that's in that policy, it's never going down. Even this year, it's going up again, right? So a lot of my clients who have we always have the two. They can't just buy one product, so they'll have RSPs, TFSAs, and various things. They fluctuate in value. Policies we do are steady growth, right? We just see that those policies. That's why financial institutions love these policies, because they are literally 100% guaranteed. So he'll continue building that until age 65, and he says, "Well, I want $25,000 out of it." Well, instead of being taxable income, we can get him actually non-taxable income. So he's going to get more money from that $25,000. He's going to relatively have the same amount of money at 86. The biggest difference here is the estate. And this comes down to the capital dividend account that you're talking about. So what we've done is switch the money from a taxable corporation to a non-taxable corporation. Because at the end of the day, this is, if it works out perfectly, he's only going to be, that corporation is going to be, they'll only have that let's say that life insurance policy in place. So when everything gets wrapped up, it gets paid out through the CDA, and everybody gets more money, right? So on this side, we pay very little tax. And again, it does this very well, right? But there's other things that you have to be aware of, these things, right? So on this side, most people would very strongly consider doing something like this, right? Okay, so example 2 is just a husband and wife, and they're retiring, right? And the timeline is they're at retirement. They sold their business or their land, or they just built up $1 million in their corporation or RSPs. I mean, if it's corporation or RSPs, and this is an example, it doesn't make a huge difference, but it does, there's slight variations, right? So I talked to the client. Client says, I want to spend half of it, and I want the other half to go to kids, right? But I still want to be able to access that money in case I need it, right? So let's say we live too long and whatnot, right? So what we've done is we invested half of it, and the other one we filter into a life insurance policy over a 10-year period. At the end of the day, when you're 85, again, we've gotten rid of all the taxable stuff. If it's the RSP or the money in the corporation, we've got rid of all those assets, right? And what's left is the life insurance, which has almost $250,000 in it. So at that point, if the client wants money and needs more income every year, we're going to get that money from this on a tax-free basis, and we're going to get that to the client. But what happened, both mom and dad, the couple have passed now, at 86 years old. and the net estate value is 910,000, almost the same as what we started with. And so, clients look at this and go, okay, well, that makes sense, right? What if we didn't buy it? What if we just invested it, right? We can run those numbers all you want. It's never going to be the good, because half of it will go to the government, because there's no credit to a CDA account on that kind of concept, right? So we use, every time we look at people's estates and values, we really want to dig in a little bit and look at what, because it's not for everybody. Like, I think that you know you definitely have to fit a certain profile, but it's definitely, your numbers might not look like this, right? So if they don't look like this, we don't want to do it, right? We don't want, if this option is not better than the other, then why are we showing it, right? And so if it doesn't work, we're not going to try to make it work. But what I have to say, the moral of the story is, I think everyone should have the opportunity to say no objectively to permanent life insurance. I think it's something that definitely could fit in your financial picture. If it doesn't, I'm happy to tell you, right? But if it is something that looks like it would work, I think it's something that you definitely should consider. Um, so, you know, uh, do you see a lot of life insurance stuff going on, and when it comes to corporations, and
Yes,
have you
when
seen stories like that?
arguably we're seeing more of it. Now where it works well, where we find it works well, with especially our corporate clients, is those clients who have started earning that excess cash in the corporation, that they don't need it to be reinvested in the business, and they're going to be putting it aside,
Mhm.
either for their retirement or for their eventual estate planning. So it is something we're seeing more and more of. Now, to be clear, I guess, or to be honest, is where I've seen it and we're seeing it work well, is there needs to be a commitment and an availability to put into the life insurance. Right.
Mhm.
I personally, I probably wouldn't tell my clients, well, we'll use a little bit of your numbers, like, hey, $25,000 a year. Well, you better find 25,000 to put into a life insurance policy. And like, well, I don't have
Yeah,
that kind of money,
it's still
right?
good.
Or like,
Yeah.
what kind of money do you possibly have? Like, we'll have those discussions for sure about the importance of planning for the future, especially
Absolutely.
with a corporation. But I would never want to put a client into position of
Yeah.
saying, well, we are only talking about excess cash here,
Yeah.
things that you don't need to access or plan to access, on the short or medium term.
Yeah.
And if so,
And
that
that's,
works really
yeah.
well.
And thank you so much for making that point, because I think it's critical that these, when we're doing stuff like this, it's never, you can't impede business in any way, right? It has, one of the main questions I always ask, is it, so if we're doing this, is it hampering your business in any way? What can you see that won't make you, and if we're not getting good answers, if we're going, well, I don't know, I mean, maybe 5 years from now, business turns around, right, and we can't do it, then we want to make sure that's kind of cleared up, because, like, it's not something that, one of these type of plans, if you're just investing money, you can just simply put in the investment, and if you need to stop, you stop, right? With permanent life insurance, you're a bit more, you have to have certain commitments, especially for the first 5 years in that policy, right? So we want to make that clear to clients and whatnot as well. So um,
I guess
so
the point I would like to make, though, is at the very least, you should be asking questions,
yeah,
right? Ask
yeah.
questions to the professionals, that are part of your team, regardless if you're a corporation or you run a business or not. That's what professionals like Ray and I are here for, is to kind of explain these to you, see how your situation can be planned for, or fit into a certain, uh,
Hmm.
I guess, product or plan,
Right,
right? And if
right.
you don't ask the questions, then you're not further
Yeah,
ahead, and it's
yeah.
okay not to know it all.
No,
Like,
yeah.
I definitely don't
I
know it
don't at
all,
all. Yeah,
and listen,
yeah.
I don't even manage my own investments. Like, I probably could figure it out, but
Yeah.
um,
Why would you want to? Right?
we focus on the things that we do best. I focused on accounting and tax, and I reach out to Ray when I've got investment or planning or retirement planning or even estate planning. That's what we do typically as professionals, or that I should say, that's what good professionals
Yeah.
should be doing.
We're doing, right? We're focused on the client, and really, at the end of the day, we want to make sure that, or we want to put as much effort we possibly can. We're not perfect, right? But at the same time, we can't control how much effort we put into working with our clients. So we're out of time. So I hope that the hour went fairly quick for most people, right? I hope we made it somewhat interesting. We love to hear from you. Just give me some comments. My email and Jason's email or Justin's email is very easy to find. I think we should have put them up a bunch, I guess, but um, definitely reach out and let us know how we did. And if you have any questions, even if it's for Justin, if you email me, I'll make sure he gets them, and vice versa. So I want to thank everybody's attention. We held everybody's attention for the full hour, so I think that's always a very positive thing. So thank you, Justin. This has been a lot of fun. I hope you enjoyed the hour. So
Yep. Thanks, Ray, and thanks for everybody for participating.
all right, everybody, take care.